Hey friends, Kevin Goehring here, your Sacramento, Stockton area realtor and lender here with this week's weekly real estate report. Boy, we got a lot going on in this week, so let me take you right over to the chart and we can talk about what is happening. So, all right, go down here to the available homes on the market. Well, we went up, up, up. Last week we went down a little bit, and now we're going back up a little. I would really expect to see this climb more. This is not a good sign. I'll get in that in a minute. Pending sales continuing to go up. This week we saw just a slight drop, also kind of a weird thing. Got some ideas on that. Let's talk about the median sales price here. We definitely saw a little plateau for a while, went up hard last week. Back down a little bit, but like I was saying last week, this is going back 30 days. So when we take a step back and take a look at what's happening, what I don't have on this particular chart, but I do keep track of, is the median price for homes listed. Now that's what's happening right now. What happened this week? I've been watching this number go up, 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 and up, and kind of wanting to see what's going to happen with that. Well, we started out, we can go back to the first of the year when the median list price was about 620. Then it went 625, 640, 640. Kind of held there for 640 for a while. We're sort of seeing that right around here where we saw the median sales price also go stagnant. But the last 2 weeks have jumped up $10,000, actually more than 10,000. So we're at 640 basically, went 633. Now we're at 650 really, 649, 650. So that number keeps going up. Now, when we take a look at rates, we'll back up, go over rates right now. You've been watching the news. Rates are going up. So last week, Freddie Mac was reporting the median rate, or the average 30-year fixed rate was 4.42%. This week it jumped up 20 some basis points to 4.67%. So from 4.42 to 4.67. I'm seeing some news articles saying this is the biggest jump we've had in 40 years. Doesn't matter how bad it is. It's a big jump, right? Okay, so historically speaking, we have always said that when rates go up, home prices are going to go down because the payment is going up because of rates. Therefore, the sales price has to go down to compensate for that. But I think we're in a bit of a perfect storm here that's not going to allow what is normal, because let's face it, this world is no longer normal and following the norms. And so it's kind of hard to look back and say, this is what will happen. So let me say, this is what is happening. So, all right, so we've had this rate increase. What does that do? So if the median sales price right now, looking at the chart we looked at, the yellow chart, is $600,000 basically. So last week, $600,000, the median rate would have put your principal and interest with 20% down at $2,409. We'll call it $2,410. This week, the same median sales price home at the new rate with 20% down. Keep in mind that means your down payment also went up a little bit, but now it's $2,480. So we've had a jump of basically $70 a month in payment on the same house. Now, normally, like I said, that would start driving home prices down, but we're looking at kind of a perfect storm here of things going on. So what is happening? Why are buyers not backing off? Well, what's happening in the rental market is rents are continuing to go up. So buyers are looking at that saying, look, I know home prices are crazy. I know rates are going up. Rates are not crazy. Let's don't go there. Anything below 5 is still a fantastic. Anything below 6 is a great rate, really. But okay. So buyers are not backing off. They can't because rents are going up too fast. There's still a significant shortage of homes, the green line. So that is causing buyers to have to go out and still pay the high prices for homes. Lastly, we know that the Fed keeps saying they are going to raise rates. Now they're saying they were going to raise them 0.25%. Now they're saying, look, that is not enough because we're headed for some serious inflation. We're going to maybe do 0.5%. So that says that rates are going to go up even faster, even higher, faster and higher. Yes, they're going to go up a lot. And so that leaves you in a position as a buyer to look at the market and say, well, yes, home prices are crazy and it would be fantastic to just back off and wait. But unless we see a significant housing crash, what we're going to see is rates are continue to go up as well as home prices. So I think that there's a potential that we could see, well, I don't think there's a potential, there is a potential that we could see home prices and rates go up at the same time, making homes even less affordable. Yeah, kind of a scary thought. But that's really what is happening. And again, why? Because rents are going up so fast and so high that it still makes sense to get into a house. So you get into a house right now, yes, you paid a lot. Yes, your rate could have been a lot lower, but it is going to get a lot worse. Now, I just want to caution you, last little point here, that as rates go up, there is a tendency for lenders to push adjustable rate mortgages. Don't go there. Rates are not going to get better. Adjustable rate mortgages are fantastic if you think that, wow, a 30-year fixed rate is going to be up here, but an adjustable rate is here. And I think rates are going to head down over the next few years. Then by all means, adjustable could be a good, I don't like adjustable. I'm just going to say right now, I would never take out adjustable rate. I'm a fixed rate kind of person. I like security. I like knowing that this is my payment today, and 30 years from now, 20 years from now, that is my payment. I don't like adjustable rates. I don't sell them as a lender unless you really, really ask me to do it and kind of force the issue. I'm still going to talk you out of it. I think your fixed rate's the way to go. So be cautious. Don't accept an adjustable rate mortgage thinking that rates are going to get better, thinking that something's going to change and you will be able to deal with it later. That is how we got into the last housing foreclosure crisis, because too many people took adjustable rate mortgages because they could not afford a 30-year fixed, hoping that something would change down the road. If something did change, you lost your equity and rates went up. And that, and you know, the whole crash, don't need to get into that, right? Make you feel bad. But that's what happened. So do the smart thing, get the secure loan, get the 30-year fixed. All right, guess that's it for now. So thank you for watching, and I hope you guys all have a great weekend coming up, and I'll see you next week. Take care. Bye.